So let's get on with MACD. Now, I am what's considered a price action trader. I trade predominantly from what price is on a chart. I look and read my charts. I use chart patterns, simple moving averages, support and resistance line, and some candlestick patterns. But every once in a while, I can't make out what my price action is telling me, and I try to use an indicator that might help me further interpret what the market is trying to say. And my favorite is MACD. Now, when I go to the seminars or conferences, when I meet new traders, when I talk to my friends, everybody wants to know, what will prices be tomorrow? What will they be next week? What will they be next year? Do you know how many people have called me in the last couple of weeks, last week and a half, saying, what's going on with Bitcoin? Maybe now it's down 35,000. Maybe I should buy some. Should I sell my? I don't know. Okay, because none of us really know the answers to these questions. I'll be attending tonight's class in hopes that technical analysis using MACD is going to be some miracle cure. I'm afraid I have to disappoint you. However, if you're attending this webinar with the hopes that technical analysis and indicators like MACD will improve your investing experience, help you figure out where to put your stop losses, help you to figure out when a trade is advantageous, and let you know when the market's doing what you want, then we're on the right scale. Now, MACD was developed by Gerald Appel in the late 70s. Now, we think about trading in the 70s. Like I told you, I started trading in 72. There was virtually there was no online trading. There was virtually no computers. And we used to sit in the pits and hand chart. In other words, we sat with graph paper, making marks on graph paper. And the markets moved very, very slow. And predominantly, the only market that people really talked about was the stock market. So when Appel developed MACD, it was developed primarily for the stock market. As Forex grew larger and central banks changed and we were able to start trading Forex, even before it was online, we realized that MACD worked well for Forex trading or assets that move faster, because stocks, as you know, move pretty slowly. Forex moves a lot quicker. Commodities sometimes move a lot quicker. And MACD worked great. And it helps us spot the strength, the direction, the momentum, and the duration of a trend. Now, MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD, M-A-C-D, are just the abbreviation of Moving Average Convergence and Divergence. Now, I like it because I like saying it. The MACD indicator, which requires moving averages as an input, falls in a group of what we call lagging indicators. Now, in the marketplace, we have lagging and leading indicators. Lagging is not a bad thing. It's not like the school teacher calls and tells you your kid's lagging behind in class, or he's leading the class. Leading and lagging indicators indicate where they fall in helping you project price movement. Most indicators are what we call lagging indicators because they are behind the market, because most formulas for most indicators require the open, the high, the low, and the close of the last closed session in order to do the calculations. They're not leading it, they're behind it. So lagging indicators confirm or give you information about what has happened. Leading indicators, which are very few of, predict the future. Now, the basic function of the MACD indicator is to discover new trends and help identify the end of current trends. Now, there are various ways to gauge the signals generated by MACD, and many traders use their own unique settings and methods around using this indicator. Now, remember, yes, MACD can be easily adjusted to fit your trading system, but it means you have to test those adjustments. You don't want to adjust or change a setting to force it to give you the answer you want. So I'm a firm believer in always using the standard formulas because in all indicators, that means all that you're reading, all the history, all the back history was all based on that indicator. Now, MACD is typically placed on the bottom of your chart. That's where most indicators are. There's very few indicators that go over top of price. Things like Bollinger Bands and moving averages, but most are placed below. And MACD is a relatively easy tool to use or understand. Now, the concept behind MACD is fairly straightforward. It calculates the difference between an instrument's 26 and 12 exponential moving averages. Okay, so let me pop a chart up, a live chart on the screen, so we can see what we're talking about here. Okay, so we're looking at a live chart. This is the Euro-US dollar chart. This isn't because we're discussing the Euro-US dollar or I have something to tell you about the Euro-US. This is my standard teaching chart that I use for all classes. Now remember, we have what's called moving averages or exponential moving averages. You can put them on your charts simply by clicking the indicator. There's no calculation you have to do. And we'll go to moving average. Now, what you see, let me clean up the chart here for you a second. So we're going to start out with a 12-period moving average, and we're going to make that one dark blue for class. Okay. Let's make it broader. And you said we have the input on 12 periods. Now, moving averages on the whole are based on the close of the time period. So in this case, we're looking at a 30-minute chart. So it would be based on the close of each session every 30 minutes. Now, unfortunately, or fortunately, these new advanced Java charts give us way too many choices. You could use all these different ways or sources for all of your indicators. Well, it doesn't really change that much. And the fact is, most of us use the close. Okay, so now we have on our chart the dark blue line, which is a standard 12-period moving average. Then we have our, let's make this one, we'll make it gold. And this is going to be a 26-period moving average. So now we have, excuse me, the blue 12-period and the gold 26-period moving averages. Standard moving averages, EMAs, nothing done to them. And we can see that the different periods. Now, for those of you who don't know that much about moving averages, whenever you talk about moving average, you talk about a fast moving average and a slow moving average. The faster moving average, whatever you're using, is going to be the shortest period. Okay. The longer period is referred to as a slower. Why? Well, if you're using, say, a 5-period moving average, you would be taking the close from the last 5 periods, adding it together, dividing it by 5. And if you're using an EMA, using a little bit of an adjustment. But it would respond faster to the most recent time change than if you were using a 25 period, because then you're going back 25 closes, adding it together, dividing it by 25, and making that adjustment. So it's the slower of the two moving averages. So in this case, we have our 12 period and our 26 period. But if we were just to use these two and say, whenever one crossed over the other, we would get a buy or sell signal. Like here we see that that the slower period crossed the longer period. Here we see that the longer period crossed the slower period. Here we have a different crossover. Each one of them could be generating buy or sell signals. And they're fairly accurate, as you see. Not definitive, but they're fairly accurate. But this would simply be a moving average strategy, or what's called a moving average crossover strategy. It's the basics where we start with MACD. But what we do here now is we take the different, and this is where Gerald Rappel revolutionized the use of moving averages. What we do is we take the difference between the two moving averages at the same period, and we subtract one from the other. We take the slower one away from the larger one. Okay. And when we do that, we plot that below on what is called the MACD indicator chart. So we would start out by putting the MACD line on our chart below. And this line that we're looking at down below is simply the difference between these two moving averages above. Now, down below is plotted along a zero line. Now, what do you think the difference is when a moving average, either one, the bigger, the larger, or the faster crosses the slower, or the slower crosses the faster, is always going to be zero? Because when you subtract two identical numbers as they cross over each other, it's always going to be zero. So when we see it here on the zero line, we had a crossover. Whenever it's here, we had a crossover. If it crosses below, we know that the slower moving average was larger than the smaller moving average, and that's why we get a negative number. If the faster moving average is larger than the slower moving average, we would get a positive number. And this is always going to be the difference between whatever the number is. So you can see down here, we were all the way down to minus almost 2.20. Whatever the difference is what it is. There is no boundary for these. Okay, so we have the zero line. Now what we know is when we cross the bound to the zero line, moving upward, that would be a buy signal, because the faster moving average is now accelerating faster than the slower moving average. When it does the reverse, that would generate the beginnings of a sell signal, because that would be each one of these crossovers. Now, but this is really just basic, because all this is another way of looking at the moving average crossover from above. Now, once we have that line, we can technically get rid of these two moving averages, because MACD has nothing anymore to do with what's on your chart. Okay, we don't need those moving averages cluttering up, because we can tell everything that's happened with those moving averages in this line down below. And I just want to make this a little bit darker so that you can see it better on your side. The next step that Gerald Arpel developed was taking a 9-period moving average of this line. And that becomes what's called the trigger line. And we'll leave that in orange. And when the trigger line crosses the MACD line, that now generates buy and sell signals. What this has done is giving you a more accurate response, a more accurate information than just a simple moving average crossovers. So here, if I could draw a straight line, here we're getting a buy signal. That's telling us not only has this downtrend ended, but it started to move in an uptrend. Now, MACD doesn't tell us this way how much we can expect, where our target point would be. It tells us the momentum, and it tells us the strength of this new movement, and it tells you which way the movement will be. Here we get the crossover in the opposite direction. Here we get crossover, and it's very easy. You don't have to do any interpretation because look, anytime it's moving above the zero line, we know it's moving that way above the zero line. We know it's a buy signal. If it's moving this way below, we know it's a sell signal. Now, you don't, excuse me, wintertime heat kills me. Okay. Now, we all know that you just don't jump in the market and buy and sell. As I said to you earlier, I use this when I can't, when my price action trading, my support and resistance line, my other pieces of information are not as clear cut that I'm trying to say, what is this market telling me? And I will add MACD. The other way is you have MACD is telling you, here's a buy signal. Now, do your other bits of information to determine if you want to enter this market. So it can be either a slap on the back of the head saying, hey, here's an opportunity, go and analyze me now and make a decision. Or it's, I'm a little bit lost, help me interpret what the market's trying to tell me right now. But MACD, excuse me, but MACD doesn't stop there. MACD takes us a little bit farther. And this is why I like MACD, because MACD then takes us to what's called the histogram. Now, the histogram is simply a graphic depiction of the difference between the moving average MACD line here, the blue line, and the 9-period moving average of that blue line. Now, some of us will then not even look at the signal line and the MACD line, and will only look at the histogram. Because again, this is, nothing's moved or changed. Here's your zero line. And what we see now is anytime the histogram moves from red to green, what does that tell you? That the moving average, the shorter moving average, the faster moving average crossed over this lower moving average and moving up, and it's a buy signal. When it crosses below, it tells you exact opposite, and it gives you a sell signal. But now we can also visually see the strength of the market, and we can see how this upward movement is petering out. Okay. We can see the depth of the market here. We can see when it's a very strong, deep market, a very strong down movement. We can see when this uptrend is losing its momentum. So we can actually look at this and feel what the market and the price is trying to tell us. And this is called the histogram. And all that the histogram is a visual depiction of the difference between the MACD line and the signal line that we had on the bottom of this chart. But it now accurately forecasts for you what is happening in the market and gives you strong entry points or exit points. It will tell you if you were in the market here and you weren't sure as the market turned around whether you should get out or whether it's just going to be if it's going to recover and continue that downtrend, you would get out of your trade. If you were waiting to enter the market, now it's telling you here's an opportunity. Okay, because this downtrend has ended and we're about to go into an uptrend. So it helps you to understand the difference between reversals and retracements also. Now, there's many ways we can take MACD, hold on a second, and combine and add it into our trading strategies. So as I said before, hold on, I just can't get my marker off here. The MACD histogram is an elegant visual representation of the difference between the MACD and its 9-day or 9-period EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA or 9-period. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principles work in reverse as prices are falling or rising. Now, keep in mind, a lot of indicators out there do not adjust well to fast-moving markets and do not adjust well to short period time frames. A lot of people want to use a lot of indicators that work really well if you're looking at an hour chart. But when you go down to a 15-minute chart, a 5-minute chart, and you're trading like we do in, especially if you're a fast trader in CFDs and you're trading fast-moving assets, okay, some of those indicators don't adjust quick enough to give you up to the minute accurate information. So what you can think of as MACD is a highly interpreted probability signal that is based on the difference existing between three moving averages and its histogram. While it is slower than momentum indicators such as stochastics and relative strength index or commodity channel index, CCI, if you are willing to sacrifice a little speed, it's good to keep you, it will keep you on the right side of the markets. Now, the MACD is perhaps the best all-around study available. Indeed, Appel considers MACD to be the best single oscillator available, and it's valuable to learn its nuances inside and out, because we've talked really the real basics here. We haven't gone and looked at other ways that you can use MACD yet. We'll get there in a second. So other than the price trend itself, MACD is one of the most accurate probability signals. The new trader would be wise to concentrate on really learning the MACD and its histogram before moving on to other oscillators. Too many new traders, okay, first of all, don't even stop and build themselves a trading system or strategy. And they put a whole bunch of stuff on their charts because somebody told them to do all this. And they just trade like puppets without ever learning how to use the pieces of the puzzle that they have and really understand what it's trying to tell you. So as I said, I don't use any other indicators. I use price action, support and resistance, and chart patterns because I'm a price action trader. MACD is the only one you'll find on my charts. And that just helps me as an interpreter because indicators are interpreters. Because indicators are only based, all indicators are mathematical formulas based on open, high, low, close, and volume. That's the only information they have. Now, in downtrending markets, we already discussed that the fast-moving average will move down faster than the slow-moving average. Now, MACD can help us in several ways. First, we want to keep our eye on that zero line, not just because that's when it told you it's generating buy and sell signal. We want to look at the velocity in which the MACD is moving above or below, because it's going to help us see the speed and how strong and what kind of momentum it has. Because if it just breaks above, they cross each other, but it's not showing you any speed, it means there's not really that much conviction in the market. So we want to be well aware of when it's breaking the zero line, okay, and then how far it peaks above the zero line. Now, MACD gives us three different stories. It tells us, now MACD proves most effective in wide swinging trading markets. It gives us convergence and divergence, crossovers, overbought and oversold conditions, and divergence. Now, crossovers are what we've been talking about. It's a really simplistic, basic piece of information, but it does give you high probability information. Then it tells you overbought and oversold conditions. The MACD is also useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, it's rising, it's likely that the symbol of the asset is overextending and will soon really return to realistic levels. We can see this in the depth of the peaks and the valleys. We also get divergence. Divergence is one of those things that we talk about a lot in the market. You'll read about it a lot. Now, I don't have a problem with divergence. Lots of people lecture about it. Lots of people use it for everything. I just never see it, is my problem. Divergence is when, I'm not saying it doesn't exist. My eyes just don't catch it. If you point it out to me, I see it, but my eyes don't catch it when it's happening. Divergence is when the symbol, the asset you're trading, is moving, say in this case, a downtrend, and the trend of the indicator is moving in an uptrend. Okay, what it has is you've got divergence between the price of the actual price action and the indicator. Okay, when you get this, you're getting what's called bullish divergence. But seeing divergence, okay, you're still going to get a crossover. You're still going to get the breakout, and you're going to get the entry point. So catching the divergence may give you a forewarning, but like I said, I never recognize it. My eyes just don't catch it. Now, remember, when you're trading with MACD, I only look at the histogram, and MACD is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a fourth derivative of price. What's the first derivative? We looked at it. The 12-day EMA and the 26, the 2 lines we put on the chart on the top. The second derivative is what's called the MACD line. It's the difference between the 12 period, which is the fast moving average, less the slow moving average, the 26 period. The third derivative is the 9 period moving average of that second derivative, or the MACD line, which is called, remember the blue line, that's called the MACD line. And then the fourth derivative, the third derivative, is the signal line, which is the 9 period moving average, which is the 9 period moving average of the MACD line. And then the fourth derivative is the MACD histogram, which is the MACD less the MACD signal line. The base of this indicator is the asset's price. It takes 4 steps to get from the actual price of the MACD histogram. So talk about massaging data. Well, not necessarily a bad thing. Charters should keep in mind that when analyzing the MACD histogram, it's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which is in turn is designed to identify changes in price momentum of the underlying security. Now, as with MACD, the MACD histogram is also designed to identify convergence, divergence, and crossovers, all of which I've shown you on that histogram. The histogram is positive when the MACD is above its signal line, and the positive values increase as the MACD diverges. In other words, that peak that's growing up there, or the valley. Now, it's become standard to plot a separate moving average alongside the MACD, which is used to create a clear signal of shifting momentum. So that's the MACD line and the signal line. And it's said when they cross, they give you those transactions when it crosses 0. Because whenever 2 lines cross and you're subtracting one value from the next, it's always going to be 0. So the basic bullish signal, the buy signal, occurs when the MACD line crosses above the signal line. Okay, and let's consider it a bullish signal. I hate saying it's a buy signal. It's telling you, hey, trader, take a look at me. There's an opportunity here because the market's becoming bullish, or just the reverse. Now, I keep mentioning the center line to you. As mentioned earlier, the MACD indicator is calculated by taking the difference between the short term and the long term. Given this construction, the value of MACD indicator must be equal to 0 each time the 2 moving averages cross each other. Now, this is a very simple method that can be used to identify the direction of the trend and key points when momentum is building. It's crossing either above 0 or below 0. And as those peaks or valleys are growing, that's the momentum that is growing. When that momentum, that valley, that peak starts to move down or loses growth up, getting a higher mountain or a lower valley, you see that the market is losing its momentum. It's not necessarily reversing itself, but it's either building momentum or losing momentum. So let me take you over some live charts, and let's take a look at a couple ways that MACD is used. Okay. So here we see the signal line, okay, and the price movement. Now here we're using MACD and the transaction, where we've used our support and resistance. We've used what we expect the markets to do, and we're waiting for MACD to help generate the point in which we want to enter the market. We've already set up our strategy. We're waiting for something that's going to confirm entering or exiting the markets. Again, here we've used it in combination with RSI, support and resistance, and we have a chart pattern here. We have the histograms rising. We have a bullish crossover the MACD, and we see RSI is starting to move in a momentum upward, although the RSI has not broken above or below the 80 or the 20. Okay. So this is telling us maybe this is not an opportunity. Maybe it's giving us some information because the market is shifting, but not enough to make us make a trade or a profitable trade. Again, here we can see in this case, we can actually see the bearish divergence. Indicators moving down, market is moving up. Ooh. Uh-oh, I'm sorry. Where's my undo button? There we go. And here we use a combination of MACD, and we see the divergence of MACD, the divergence in the RSI, and we have price moving upward. So there's many different ways you can combine this into your own trading strategy and how you're going to use it and what interpretations you will use. But MACD is a great all-round indicator. Now, there are some drawbacks. The biggest disadvantage of using this indicator to generate transactions that a trader can get whipsawed in and out of positions several times before being able to capture a strong change. Because remember, I said to you, what MACD doesn't do is tell you how far the market's to move. It's telling you there's a bullish opportunity here, but the market can move up for a couple pips or for the next 2 seconds, but not enough to make any profit, and then go back down again. MACD's only saying there's a bullish opportunity here. Do some other analysis. Now, keep in mind it's a lagging indicator, but all indicator, you need to be able to figure out how far you think the market will move or where the target points are, where you'd have to put your stop loss, because MACD doesn't tell you that. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets. So because relatively small movements can cause the indicator to change direction quickly, a large number of false signals can result in a trader taking many losses, especially when commissions or spreads are factored in. Another MACD drawback is inability to make comparisons between different securities. MACD is a freestanding thing that works below. You would have to, and this is one of the reasons you don't want to trade many assets all over the place, because you'd have to understand exactly what MACD usually does with the asset you're trading. You know, we have some firm rules, but don't go overboard and just dump it on all of your chart and expect it's going to look exactly the same, do exactly the same in a stock chart as it's going to do in a currency chart. But the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easier for traders to ensure that they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than MACD, and this relatively simple indicator can quickly be incorporated in any short-term strategy. So momentum is, in charting, is like momentum in physics. If you throw a ball in the air, it will descend at a slower and slower pace the higher it projects upward. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descend. So you can with MACD and the histogram. So just like in physics, momentum changes occur before the price of an asset changes. Now remember, I said in the beginning class, if you have any questions, just type them into the window and someone will email you back a defined answer. Now, and I also said in the beginning, this class has been recorded. In about 24 hours, you can use the same link you used to come to the live class to see a recorded version of tonight's class. So thank you very much for joining us. But again, please type in your questions. We monitor them. We promise to answer them. Okay? We're here to answer all the questions. So thank you very much for joining us tonight. I hope you learned a little bit about MACD and you start using it in your trading to improve your future trading. Thank you very much and have a great week. Bye now.